welcome to Paisa Live. We have Mr. Anshoo Sharma with us, who's the co-founder of Magicpin. So first of all, welcome.
Thank you for having me here.
You know, such an insightful and interesting session it was, the conversation, and you have mentioned repeatedly that things have changed. The ecosystem has evolved. VC ecosystem has evolved. VD ecosystem has evolved, and so it has become founder friendly. So, what do you mean by the term founder friendly? How have things evolved in the past 5 to 7 years?
Yeah, Shahdan, I've been working at Magicpin for 10 years, and before that, for 6 years, I was at Lightspeed, also on the venture equity side, right?
Okay.
So if I look at this entire, let's say, close to 2 decades,
Right. That's a very long time.
Right?
Yeah.
We started with venture debt being a relatively rare commodity and being offered by just one player.
And
in
not
India,
known by almost everyone.
right?
Yes.
And it was considered to be, startups considered to be entirely an equity business model. And the amount of equity also when we started was relatively lower. I think over the years, as India has matured, India's technology ecosystem has matured, equity has become deeper and venture debt has become a lot more mature.
Right.
It's reflected in the number of players operating in the venture debt market. It's reflected in, it's not just coming along with equity, it's actually coming as credit, like for mature businesses, because businesses have become mature. We've taken venture debt 3 times. The first time we took it, it was because that capital was very valuable for our base at that point in time, right? This time, second time we took it, and then this time we took it. What has happened is that it's not just the company, it's the use case that we have for the capital that is getting financed with debt. And equity capital is always much more expensive than debt. So the fact that the market has that maturity and players like Stride are figuring out these ways of capitalizing companies, which is not just equity, is great. Your question around how is it founder friendly?
Yeah.
I think the fact that
How it has become founder friendly.
how it has gone from just being debt on the
Existing,
company's
yes.
equity against that to becoming something which is for the use case.
Right.
And then in terms of the terms also, the flexibility which exists now around the tenure, the moratorium, which is again tailored for the use case of the company versus how it used to be in the past. I think all of these things have made it a lot more favorable and usable than what it used to be.
And how difficult it is or how correct it is for a founder to evaluate that, okay, fine, now is the time to repay it. Like you have to have that clear decision in your mind.
Debt comes with the scheduled payment cycle.
Right.
You have to
But you have to
service the interest.
but you have to exit.
It depends again, right? The provider of debt needs it to be serviced and paid back, but the provider of debt also wants more debt to be deployed.
Right.
Right? So to that extent, you can service it, pay it back, and then take more, provided you have a use case. So I think it exactly depends on the business. It's not that you have taken debt and you have to retire all of that debt. That depends on the use case. In fact, the partnership we have with Stride, the expectation is that we are starting at a place to fund a use case, but then over a period, as the company continues to grow, more projects emerge. We look for more opportunities to partner together.
Right. Well, thank you so much, Anshoo. What
My
a lovely
pleasure, Taha.
conversation.
Thank you.
Thank you.